Financial markets today delivered a vote of no confidence in the Japanese government's handling of the country's nuclear disaster. As the nuclear problem intensified, so did the fear on equity markets. Tokyo's Nikkei Index plunged 10%, bringing the two-day fall to 16%. Interest rates also plunged as market pricing for rate increases turned to pricing for cuts. Here's Philip Lasker.
As if rebuilding their crippled country wasn't difficult enough, Japan's leaders now have the fate of global financial markets in their hands. How they manage the nuclear disaster will dictate what sort of impact it has.
People are, given sort of prior experience, a little bit untrusting of what the government is saying in terms of the situation with the nuclear reactors in Japan. So there seems to be an increasing degree of fear and panic, and that's clearly what's driving markets.
Tokyo's Nikkei Index plunged 14% shortly after reports of another nuclear reactor explosion and Prime Minister Khan's warning around midday of increasing levels of radiation. The selling spread to other markets throughout the region as investors dumped stocks. The Australian market fell another 2% to close at a 6-month low.
What these natural disasters represent is a loss of wealth, and whether it's what we saw in Queensland or in Christchurch and now in Japan.
And money markets were turned upside down as investors rushed to the safety of short-term government bonds. The market went from pricing an interest rate increase by the end of the year to a rate cut.
There's been a lot of people who are having to fall on their sword and say, you know what, I was positioned to expect higher rate increases. The market's gone completely against me. I have to get out of that trade and go the other way. That sort of adds to the dynamic that we've seen today.
And that dynamic doesn't look like changing in the short term.
It's going to be in a state of flux for some time until we get some degree of certainty about conditions being under control in those nuclear reactors.
It's hardly surprising then that the Reserve Bank did not want to add to its latest board minutes released today, reflecting the meeting held earlier this month before the earthquake struck Japan.
I'm not really going to talk about the macro outlook today, sorry. I'd rather just answer questions about the topic under discussion today.
Which was the Australian bond market, where the patterns reflect a weaker household sector, reducing borrowing, and a booming resources sector.
If you think about the composition of growth in Australia in the period ahead, it is likely to be investment intensive, and that's certainly embodied in our forecast. But much of that investment is likely to be funded by companies which are cash rich or tap global markets directly. So this means that the growth in the economy in the period ahead should be associated with less growth in business credit than has been the case in the past.
Right now, though, investors are looking no further than the next 24 hours, hoping the nuclear threat will be contained.